everybody? Welcome back to Teaching Thursday. We got a great topic for you this week, and we're going to talk about Forex trading, which is dealing with foreign exchange. So as you can see here, I have the title Foreign Exchange, and I capitalized the 4 and the X because it's a Forex market. So just like when you think of the New York Stock Exchange or the NASDAQ, those are a security marketplace. Forex is actually a foreign exchange marketplace where you can exchange currencies. You can trade the currencies and make money. It's also called FX for short. And so the way it works is foreign exchange are trading currencies in the form of pairs because you're always going to compare one currency to the other based on the exchange rate. So if you have $1 and €1, if those are equal, then the exchange rate is going to be 1. So when you're dealing with these exchange pairs, imagine that a pair is going to be like a stock. And a pair can be, let's say we have the euro compared to the US dollar. Or we have the Japanese yen compared to the US dollar. So basically we had the euro and the dollar, or we had the dollar and the yen. And so what happens is when you have these pairs act almost like a stock. So when you buy stock in a company, you're hoping that the company is going to do well and the price will go up. And if a company is going to do bad or they're doing bad, you're usually going to sell to save some of your money. So think about when you're buying stock in a company, you're getting ownership in the company. When you're buying these currency pairs, you're actually buying into one of the currencies based on their economy or getting a piece of their economy. So if you have the euro and the dollar, and if you buy this currency pair, you're buying into the euro hoping that the economy is going to go up in terms of the foundation of the euro. Same thing with Japanese and US dollar. If you're buying this, then you're banking on the Japanese yen is going to increase, meaning that their economy is going to do well. And the reason that you're banking on these on the left is because on the left side, you're going to have what is known as the base currency. And on the right side, you're going to have what is known as the quote currency. So when you're buying, you're basically basing it off of this. You're buying into this. You're spending this much in the US dollar to get this much in the other currency, banking on that currency to go one way or the other so you can make some money. Now, let's go ahead and say that we have the euro here. This is how a scenario is going to work out. You have the euro here and you have the US dollar here. Now, if we have an exchange rate, which is this right here, of 1, that means that 1 US dollar is equal to 1 euro. Now, let's say that you're expecting the US economy to, do well. It's about to be a powerhouse. And you're going to bank that the US dollar is going to do better than the euro. So what's going to happen is, since you're basing it off of the euro, this is the base pair, you're going to sell this currency pair. And you're going to sell it as you're selling the euro. You're not necessarily buying the dollar, you're selling the euro because you expect the euro to be bad. So when you sell this currency pair, and let's say the U.S. economy actually increases, it becomes a powerhouse like you thought, and this exchange rate actually becomes 1.5. That means that for every 1 euro now became $1.50. So that means that when you started, you spent $1 to get 1 euro. But now, since the euro decreased because of the U.S. economy increased, that 1 euro is now equal to $1.50 instead of $1. So when you subtract $1 from $1.50, that means that you made 50 cents. And so imagine you spent $1. So imagine you spent $100. Well, if you move that over 2 places, you just would have made $50 off of spending $100. That's a 50% gain off of a 50-cent change. Now, mind you, in Forex, it usually tends to go out to 3 and 4 decimal places. So you might see something like 1 to 1.1125 or something like that. So, I don't want to just make you think like you're just going to get these 50-cent changes. The economy would have to extremely crumble for that to happen. But, if you're going to get these changes of, let's say 1.1125 to 1.11225, depending upon how many currency pairs you bought or sold, you're still going to make money off of it. You just got to find out what's going to be best and what what's your maximum potential, how much money you want to make. So in essence, to recap, Forex is just simply trading foreign exchange, trading currencies based on the exchange rate. And they're always going to come in the form of currency pairs. There are these major pairs, which tend to be with the US dollar, the Japanese yen, the euro, Swiss franc, I think a couple others. But the US dollar tends to be in a majority of these currency pairs because the US economy is just dominant. It's so diverse in terms of acceptance. So when you have that and you trade these currency pairs, you still have to always remember that when you're buying these pairs, you're buying it like a stock. You're buying the stock, you're selling the stock, and you're basing it off of the base in the pair. So if you're banking on an economy to do well, you're going to buy that currency pair based on the economy right here on the left side that you expect to do well. If you expect another economy to fall off or do worse, you're going to sell that currency pair expecting that left side to go down. So once again, if you expect the US economy to do well, relative, that means that the European economy or the euro is going to do worse. So this will go down, which in essence increases the dollar amount. You're going to make money. If you're expecting the euro to do well, then you're going to buy this currency pair. And now the euro, if it performs like you think, is going to go up, and so the dollar is actually worth less. But now you hold euros, so you hold that, and then you're just looking for another opportunity to go ahead and sell the euro to make your money back on the dollar. Forex market is the largest financial marketplace in terms of amount of money traded every day. The Forex market is open 24 hours a day. So you know that when you buy and sell stocks, you have to buy them between certain times during the day, Monday through Friday. With the foreign exchange or Forex market, money never sleeps. So you can buy and sell currency pairs all day long. If you get off work at 5 and you couldn't get in the stock market, or the stock market is closed and you already did what you did during the day, you can now do the Forex market in the nighttime. So in a nutshell, that's pretty much the Forex market dealing with foreign exchange. We talked about the currency pairs, we talked about the exchange rate, and we talked about how you can make money in trading currency pairs and foreign exchange.